Welcome back to the Deep Dive. We are digging into the Bulls, Bears, and the Bell Morning Edition for November 10th, 2025. And what we're seeing today is genuinely fascinating. There's this massive risk-on rally happening. But, if you only look at those surging equity numbers, you are absolutely missing the internal strategic conflict the market's having with itself right now.
That conflict really is the story today. Our mission basically is to give you a shortcut past the obvious relief rally. We want to zero in on that contradiction lurking just beneath the surface. What it comes down to is the market is placing two totally opposing bets on where the U.S. economy is headed, and, well, only one can be right.
Okay, let's unpack that immediate surge first. The driver seems undeniably political. Washington actually managed to broker a deal.
Yeah, finally. That procedural Senate vote, 60-40, it signals the end is imminent for that painful, record-breaking 40-day government shutdown.
The one that basically froze the flow of all that critical government economic data.
Exactly. It left the entire investment community guessing, flying blind for weeks.
So taking away that huge uncertainty, that's like pure psychological jet fuel for the market.
Absolutely. It's a collective thank goodness that's over moment. And you see capital rotating really rapidly out of safety and into equities. It's pricing in renewed economic certainty, or at least political certainty.
And we see that rotation clearly in the equity futures breakdown, don't we?
Yeah.
Tech's leading the charge as usual.
Yep. The NASDAQ 100, the NQ100 futures we track, soaring, up about, 1.2% to 1.3%?
Something like that. And the broader S&P 500, the ES Summon futures, also strong, up 0.7% to 0.8%.
Right. But here's the strategic nugget. Pay attention to this. Look at the Dow Jones, the YM00 futures. That's the older, more industrial economy. Lagging significantly. Barely up 0.2% or maybe 0.3%.
Okay, so that spread, that gap, that's the key here, right? It's not just like general excitement across the board.
Not at all. That massive difference between the NASDAQ's pop and the Dow's sort of muted move confirms this isn't a generalized recovery. It's specific. It's targeted. It's a reversal.
A reversal of what?
Remember last week, investors were dumping high-growth tech names. They were worried about valuations, especially anything tied to that AI valuation narrative.
Right.
So the shutdown resolution, it provided the perfect concrete catalyst to just jump back in and buy the dip in those specific tech stocks. It signals confidence, maybe, that the Fed isn't about to slam the brakes and crash the economy immediately.
And that confidence seems to be echoing globally, too. Overnight moves were pretty big.
Huge. South Korea's KOSPI PI surged nearly 3%. Europe's fully participating, the STOXX 600 up 1.1%. And the UK's FTSE 100 is trading just, 10 points shy of its all-time record highs, 9,777.
Wow. So global markets are clearly pricing in the end of the political gridlock here.
They're pricing in strength, stability, maybe demand restoration. But, and this is the big but, this leads us directly to the massive paradox you mentioned earlier.
Right. If risk is so undeniably on, why on earth is gold, the classic safe haven, also surging?
Yeah, that's genuinely strange, isn't it? Gold's pushing towards $4,090 an ounce, hitting a 2-week high.
Which makes no sense.
Yep.
If the world's feeling confident enough to buy tech dips and push the FTSE towards records, gold should be retreating, shouldn't it? Dramatically.
It absolutely should, in a normal scenario.
So why isn't this gold rally a traditional risk-off signal? How do we know?
Well, we can actually prove it's not risk-off. Just look at the other main safe havens, U.S. Treasuries and oil prices.
Okay.
If capital were really fleeing risk, truly scared, it would pour into the safety of government bonds, right?
Right, yields would fall.
But they're not. The 10-year U.S. Treasury yield is rising. It's trading around 4.14%. That confirms capital is actually selling bonds.
To rotate into risk assets like stocks.
Precisely. So bonds confirm. Risk on.
Okay, a bond market agrees with stocks. What about energy? Oil.
Oil is also confirming the demand expectation story. WTI crude, it just breached $60 a barrel.
On hopes that ending the shutdown restores U.S. economic demand.
Exactly. Demand for travel, for industry, for everything. That's another firm risk-on signal. Higher expected demand equals higher oil prices.
So here we are. Equities surging, bond yields rising, meaning bonds are selling off, oil prices climbing, all screaming risk on.
Yeah.
And yet, gold is soaring. It feels like the market's stepping on the gas and the brake at the exact same time.
That's a perfect analogy. The gold rally isn't a flight to safety. It's something else. It's a specific, proactive bet against the economy's underlying resilience.
How so?
It's basically a dollar-driven wager, a bet on a future Federal Reserve rate cut, Maybe as early as December.
And this bet isn't based on the government data that's about to come out.
No, because that was frozen. This bet is based on the severe economic weakness that was quietly signaled by private sector data, the stuff that did come out during the government data blackout.
Okay. That's where the memory of the shutdown damage comes back. We saw things like that Challenger grain Christmas report.
Right, showing October job cuts were the highest since, what, 2003?
And consumer sentiment tanking to its lowest level since June 2022. Nasty numbers.
Exactly. Those private data points suggested serious, maybe deep economic damage was already happening. Damage the official government data wasn't reflecting yet. So the gold market is essentially saying, yeah, we're happy the government's back. But the political mess inflicted wounds, deep wounds. And those wounds will force the Fed to ease policy very soon.
Okay, so this is the crucial takeaway for you, the listener, right now. You are watching two conflicting narratives playing out simultaneously. Equities are rallying hard on the end of political uncertainty that's a bet on strength returning, but gold is also rallying, betting on the presumed economic damage from that very same uncertainty, which implies weakness and forces Fed rate cuts.
It's like market cognitive dissonance playing out in real time. Fascinating stuff.
Okay, if the market is this, let's call it schizophrenic, at the macro level, where does that conflict show up in individual stocks? Let's zoom into the micro view. Let's look at key movers and try to separate the real fundamental shifts from just, speculative froth.
Sure. Well, the AI infrastructure play. That remains a favored target. Clear fundamental driver there. Look at Iron Ltd. Iron. Up, what, 6.66% this morning?
Nice number.
Yeah. That company has completely pivoted, right? Moved aggressively from Bitcoin mining into AI infrastructure. And that massive $9.7 billion 5-year AI cloud deal with Microsoft, that cemented it. This isn't just shutdown relief for them. It's a fundamental re-rating of the company.
And that demand for AI infrastructure is lifting related sectors too, like storage and memory, confirming the investment idea.
Absolutely. You see Micron MU up over 4.5%, Seagate STX up 4.3%, Western Digital WDC up over 4.1%.
Okay.
This collective rise shows that even within this big relief rally, the market's picking its spots carefully. It's not just buying any growth stock. It's aggressively chasing companies with direct, measurable exposure to that booming AI demand. That whole sector seems to be the highest conviction risk-on trade right now.
Okay, so that's strategic buying. Now contrast that with some of the pure speculative noise we're seeing.
Oh yeah, plenty of that too. Look at Integrated Media Technology, IMTE, soaring 127%.
Despite facing a NASDAQ delisting notice today for not filing financials.
Exactly. That's a classic low-float gamble, a highly illiquid stock just moving wildly on tiny volume. It's probably tied to some technical appeal process, not fundamentals. Pure speculation. Similarly, you've got Mason Glory, MSGY, up 108%. Zero fundamental news driving that. Just momentum chasers jumping in on the frenzy. These aren't reliable economic indicators.
But micro fundamentals do still matter, especially when the news is bad, right? Even on a huge green day like today. That sort of reinforces the market's split personality.
It absolutely does. Look at the decliners. Constellation Energy, CEG, is down over 5%. Why? Simple. Their Q3 earnings missed consensus EPS estimates.
How much did they miss by?
They reported $3.04 per share. The street expected somewhere between $3.09 and $3.13. So not a huge miss, but in this environment, punished severely.
Expectations are high. And the healthcare sector seems to be dealing with ongoing fallout, too.
Yeah, Centene CNC is down almost 5%. Still worried after they pulled their full-year outlook recently. But the real shocker is Molina Healthcare, MOH, down nearly 2% today, but that's after a terrible Q3 earnings miss.
How bad was it?
They reported EPS of $1.84. The consensus estimate was $3.91.
Whoa. They missed by more than half. 52.9% miss.
A massive 52.9% miss. That's a disaster for them.
Yeah.
And it really reinforces that contradiction, doesn't it? The macro rally suggests strength, but if your company messes up on execution, forget it. The market gives you absolutely no quarter if you miss your numbers.
Okay, let's shift focus a bit. Today's rally feels tactical, right? It's a relief trade. But we do have some crucial earnings that came out before the market opened today. They could provide a real fundamental test for this bullish mood.
We do. First, Tyson Foods, TSN, watching that one closely. Headline numbers are expected to be pretty weak. The real focus is going to be on segment margins. Specifically, analysts are bracing for a pretty big operating loss, maybe $118 million in their key beef segment.
Why is that?
High input costs, low cattle herd numbers. It's squeezing them. How management talks about managing those cost pressures, that'll be key.
Okay, Tyson. Then there's Maple Bear. Most people know them as Instacart, ticker CART. This report feels critical, especially since the stock just hit a 52-week low.
Yeah. Instacart desperately needs a win. They need a clear beat on gross transaction value, that's GTV, and they need strong ad revenue growth. Plus, they need convincing forward guidance to stop the bleeding. If they disappoint again, that stock could get hammered no matter what the broad market is doing.
Right. And one more.
Monday.com, MNDY. The tension there is interesting. They've got potential growth from new areas, like their CRM and AI features, but they might also be seeing a slowdown in core customer growth. Management actually warned about that, blaming Google algorithm changes affecting their marketing, so it's a push and pull.
So these earnings are kind of the first fundamental reality checks hitting the market today. But you've stressed pretty strongly that the strategic event this week isn't today's rally at all.
That's absolutely right. Today is just the warm-up act. The main event, the strategic move, is what I'm calling the data deluge.
Because the shutdown ending unfreezes that government data pipeline.
Exactly. The economic dark ages are over. Later this week, the market finally gets the hard facts it needs to try and reconcile those two contradictory narratives we talked about, strength versus weakness.
Okay, so what are the specific reports, the arbiters we really need to watch, and when do they hit?
The crucial ones are later this week. We get the official October Consumer Price Index, CPI, on Thursday, November 13th. Then Friday, November 14th is a double whammy. October Producer Price Index, PPI, and October retail sales. These reports will finally tell us if inflation is really sticking around and, crucially, if consumers actually kept spending their money despite all the political chaos in October.
Okay, this is where the rubber meets the road, where we figure out which bet wins the equity bet on strength or the gold bet on weakness forcing rate cuts. Let's connect this back. Talk us through the two main scenarios based on this incoming data. What are the implications for investors?
Okay, scenario one. Let's say CPI and PPI come in hot. Inflation is stronger, more persistent than expected. Retail sales maybe hold up okay.
What does that do?
While initially it validates the underlying economic strength narrative, the one lifting equities today, so maybe a brief cheer,
But
it absolutely destroys the gold rally and the whole rate cut thesis. Hot inflation means the Fed has zero reason to cut rates. In fact, it might mean they have to stay higher for even longer.
so bond yields would spike.
Bond yields would likely spike hard, and that spike could seriously undermine the equity rally, especially those high-flying tech names that are so sensitive to rate expectations. The market would have to abruptly stop betting on rate cuts and reprice for a sustained higher for longer world. Painful adjustment.
Okay, so good news for the economy could actually turn into bad news for the current market darlings.
Yeah.
Got it. Now, scenario two. What if the data comes in weak? Cold.
Right. If CPI, PPI, retail sales all come in cold, maybe confirming that weak private data we saw during the shutdown was real.
Then the rate cut bet pays off.
Exactly. That validates the rate cut thesis. Gold would likely surge even further. The market would start seriously pricing in Fed easing, maybe even that December cut.
But wait, if the data is weak, the economy is weak, right? Isn't that bad for stocks?
Precisely. That weak data simultaneously rips the rug out from under the economic strength narrative that's fueling today's equity rally. That tactical rally we're seeing built on just removing political uncertainty would suddenly look like it was built on shaky ground. Investors would realize the actual demand environment might be collapsing, and even though rate cuts are coming, company earnings forecasts would have to start coming down dramatically. That could be really punishing, especially for cyclical stocks.
Okay, so putting it all together, what this really means is that today, you, the listener, are watching a market rally that has priced in the tactical removal of political uncertainty. That's done. But strategically, it has somehow managed to price in two completely different, mutually exclusive economic futures at the same time.
Precisely. It's bizarre, but true. So the core strategic question for you to think about this week is pretty simple. You've got the shutdown relief trade implying underlying strength, and you've got the gold trade implying weakness that forces the Fed's hand. Which of those two opposing stories will the cold, hard, unfrozen government data hitting Thursday and Friday actually prove right? That decision is likely going to determine the market's real direction heading into the end of the year.
That is absolutely the real strategic move to watch this week. Keep your eyes glued to those inflation and consumption reports later this week. We'll definitely be here to unpack the fallout when that data finally drops. Until then, keep those sources handy.